Okay, let's unpack this. If you've been watching the energy infrastructure space, you know that corporate change usually moves, well, pretty slowly, right? Like a glacier.
That's putting it mildly, yeah.
But what happened at ONEOK Inc., okay, that is, between 2023 and 2025, it was more like a logistics marathon run at a sprinter's pace.
It really was astonishingly fast.
You're talking about a company that went from being, a specialized regional operator focused largely on natural gas and NGLs, natural gas liquids,
For the traditional core business.
to becoming this colossal, diversified, multi-commodity powerhouse almost, well, it felt like overnight.
That's absolutely the right frame for this. For you, the listener tuning in today, this deep dive is really about making sense of a huge and, frankly, incredibly rapid corporate consolidation in the midstream sector.
Midstream being the pipelines, the storage, the processing, the middle part of the energy journey.
Exactly. And ONEOK executed this really aggressive series of major acquisitions in just a tight 2-year window. You had Magellan Midstream Partners,
Right.
one huge one. Then EnLink Midstream and also Medallion Midstream. The resulting entity, the scale is just staggering.
Okay, give us the headline number.
It's an integrated pipeline network that now stretches approximately 60,000 miles across the U.S.
60,000 miles. Wow. Yeah, and spanning 4 major energy commodities: natural gas, NGLs, refined products, and crude oil. A truly diversified platform now. 60,000 miles. That's what, over 2 times the circumference of the Earth in pipeline? The scale is monumental.
It really is hard to grasp.
But here's the core tension we have to analyze, isn't it? Given the speed and the sheer size of these deals, how much value can they actually, extract from this incredible consolidation? Is it too much, too fast?
That is the entire investment thesis in a nutshell. The central dynamic, the push and pull here, is built on the potential for significant value creation through scale, through synergies weighed directly against the substantial execution and integration risks.
Which must be huge.
Oh, absolutely. Consolidating, 5 different companies into one functioning system in just 2 years? The risk is immense.
So what are they promising? What are the numbers management is putting out there?
Well, the key targets, the ones everyone's watching. Management is targeting over $250 million in annual synergies just in 2025.
Okay, that's the initial goal.
Right. But they project a total potential exceeding $450 million annually within 3 years. So a big ramp up.
$450 million a year just from combining these things more efficiently.
That's the promise, yes. And that promise is absolutely foundational to their 2025 adjusted EBITDA guidance midpoint, which is $8.225 billion.
$8.2 billion, that's a massive number.
It is. And everything we discussed today really hinges on OKE's ability to actually hit those synergy targets. That's the make or break. Okay, so let's dig into how they built this thing. Let's zoom in on the foundational deal, the one that really changed the DNA of ONEOK. The acquisition of Magellan Midstream Partners, MMP. Yeah, that was the catalyst.
This transaction closed back in September 2023, valued at roughly $18.8 billion, and that included assuming Magellan's debt, right?
Correct. A huge undertaking.
Yeah.
Cash and stock deal plus debt.
And this wasn't just like adding another wing onto the house. This was a total change in direction, wasn't it? Why was MMP the essential first domino to fall?
Well, the simplest answer is diversification and resilience. Before MMP, ONEO was heavily weighted toward, processing and transporting natural gas liquids, NGLs.
Their bread and butter for years.
Exactly. And while profitable, their earnings were largely correlated to upstream drilling activity. It was a classic supply push business model.
Meaning if producers drilled more wells?
ONEO had more volume, more revenue. But that also exposed them heavily to the cyclical nature of exploration and production, the boom and bust cycles.
So the fate of the company was kind of tied to the oil and gas rig count, you could say.
Precisely. Magellan Midstream was a different beast entirely. It brought this premier, mostly fee-based portfolio of refined products and crude oil transportation assets.
Refined products meaning gasoline, diesel, jet fuel.
Exactly. Stuff people use every day.
Yeah.
Suddenly, ONEO owned the longest refined products pipeline system in the entire U.S., transporting all that fuel.
Okay, so that shifted the balance.
Massively. It introduced a huge demand pull component to their revenue stream.
And just break down demand pull for us in practice. What does that mean for an energy company like this?
It means linking your earnings to stable, consumption-based demand. People fill up their gas tanks, airlines fuel their planes. That happens pretty consistently, right? Regardless of whether the price of crude oil is $50 or $100 a barrel.
Right. The demand is much less volatile than the supply side.
Exactly. That consumption is relatively stable day to day, week to week. So by blending their legacy production-driven cash flow, the supply push, with Magellan's consumption-driven cash flow, the demand pull, the combined company becomes far more resilient.
Ah, okay. Less susceptible to those big swings in commodity prices.
Much less. This was the true strategic pivot, transforming the cash flow profile from primarily cyclical to significantly counter-cyclical, or at least much more stable. Okay, so they established the downstream demand-driven backbone first with Magellan. That makes sense. Which brings us logically to the second phase, filling what was, looking at, a pretty glaring strategic gap in their original portfolio. Yeah, a big one.
Which was the lack of a significant footprint in the Permian Basin, the hottest oil and gas play in North America.
Right. The sequencing here, I think, really demonstrates some strategic foresight. The Permian Basin is the most critical U.S. producing region for both oil and gas, and OK absolutely needed a meaningful presence there to be a national player.
So how did they get in?
They executed this by targeting gathering and processing assets, the G&P side. First, they acquired Medallion.
Which was focused on crude oil gathering, right?
Correct. A specialized crude gathering system in the Midland Basin part of the Permian. And in the same initial move, they acquired a controlling interest in Midstream, a major G&P operator with assets across multiple basins, but critically, a big Permian presence.
And that deal was with Global Infrastructure Partners.
Yes, for about $5.9 billion in cash, closed in October 2024.
And then they didn't wait long. They quickly followed that up by buying the rest of NLink, the part the public owned.
Right, consolidating their control. That was an all-stock transaction for about $4.3 billion, closing in early 2025. So within months, they went from basically no Permian G&P to being a major player there.
This wasn't random shopping, clearly. This feels like very intentional assembly, piece by piece.
It was intensely deliberate. I mean, think of it like building a complex logistical machine, maybe like a giant railway system. By first acquiring Magellan's long-haul liquids pipeline infrastructure.
The main line's out.
Right, the lines connecting the Midwest down to the massive Gulf Coast market. OKE established the destination, the backbone, first. And that move instantaneously made those upstream gathering assets, Medallion for crude, NLink for gas, and NGLs, significantly more valuable to ONEOK than they were as standalone entities.
Because they weren't just acquiring pipe in the Permian, they were acquiring the ability to feed their own newly acquired long-haul pipes. It created an integrated system.
Exactly right. It allowed OK to immediately utilize those upstream gathering systems in the Permian to feed volumes directly into their new long-haul capacity. It enabled a fully integrated wellhead-to-water service offering.
Wellhead to water, that's the industry term for the full journey, right?
Yeah, from where it comes out of the ground, the wellhead, all the way to a major market hub or export terminal, often on the coast, hence water.
And this is where those potentially lucrative commercial synergies truly reside, isn't it?
Absolutely. It's the ability to go to a producer in the Permian and offer a single streamlined solution for their crude oil, their natural gas, and their natural gas liquids. From the minute it leaves the ground until it reaches a refinery or an export terminal on the Gulf Coast. That's a powerful pitch. Okay, so let's detail the result of this aggressive assembly. We now have this multi-commodity platform structured into 4 massive primary segments. Let's start with the historical core, which has only gotten bigger. Natural gas liquids, NGLs.
Yeah, the NGL segment remains, arguably the largest volume driver and maybe is still the central identity of OK. It covers everything from gathering the raw liquids out in the field.
The stuff that comes up with natural gas.
Right. Ethane, propane, butane, etc., all mixed together. To fractionation, which is the process of separating those NGLs into the individual usable products, then transportation and storage.
And the scale of the assets here.
T assets include about 15,000 miles of NGL pipeline and an incredible 40 million barrels of underground storage capacity, mostly in Kansas.
40 million barrels. That's a lot of buffer. Huge operational flexibility. And their fractionation capacity, importantly, is centered at the energy superhub, Mont Belvieu, down in Texas.
Right. Why is Mont Belvieu so critical in the NGL world?
Well, Mont Belvieu, Texas, is often called the NGL capital of the world. It's basically the main pricing point, the trading hub, and the distribution center for almost all U.S. NGLs.
So having infrastructure there is key.
Absolutely essential. OKE has significant capacity there, over 1.2 million barrels per day of fractionation capacity. That's where the raw NGL mixes, the high grade that they bring down from supply basins like the Williston in North Dakota or the Mid-Continent regions,
Through their pipelines.
gets processed, separated into pure products like ethane for plastics, propane for heating, butane for gasoline blending, then stored, and finally marketed either to the massive Gulf Coast petrochemical plants or loaded onto ships for global export.
So owning that capacity at that choke point gives OKE immense leverage, really.
Immense leverage and control over the flow and marketing of those valuable liquids.
Okay, segment 2. We move upstream to natural gas gathering and processing, G&P. This is the engine that feeds the system, now greatly enhanced by those Permian acquisitions, EnLink and Medallion.
Yeah, GMP is kind of the utility side of the upstream business. This is where raw natural gas, straight from the wellhead, often containing water, impurities, and those NGLs we just talked about, is gathered through smaller pipelines, compressed, and then processed.
And processing means cleaning it up.
Basically, yes. The processing usually involves cryogenic separation, getting it really cold to remove water, contaminants like CO2 or sulfur, and importantly, separating out those valuable NGLs before the remaining dry gas, which is mostly methane, is sent into the long-haul transportation pipelines.
Got it. And the asset base here now?
The new combined asset base includes over 22,000 miles of G&P pipeline and a massive 7.0 billion cubic feet per day of gas processing capacity.
7 BCF a day. That's a huge amount of gas.
It is. And the key thing is the additions of EnLink and Medallion were vital in securing high-quality, high-growth G&P acreage directly in the heart of the Permian Basin, filling that major strategic gap we identified earlier. Okay. Now, the biggest structural change, arguably, the one enabled by Magellan and boasted by Medallion, the new scale in the third segment, refined products and crude. The scale here is truly transformative. I mean, post-consolidation, this segment boasts roughly 14,000 miles of pipeline dedicated to crude oil and refined products.
Plus terminals.
Plus 53 refined products, terminals, think truck racks, where gasoline tankers load up 4 marine terminals for loading ships, and approximately 115 million barrels of storage capacity for crude oil and refined fuels.
Wow, that's enormous capacity.
It is. And consider this. The refined products pipelines alone, the ones carrying gasoline, diesel, jet fuel, provide direct connectivity to nearly half of the entire U.S. refining capacity. Half the country's refineries are hooked into their system. Directly or indirectly, yes. This isn't just about volume, it's about unparalleled market access and penetration. And importantly, it provides that stable, demand-driven revenue stream we talked about, tied directly to the consumption of transportation fuels across the country. Very steady business. And finally, the fourth pillar, the natural gas pipeline segment. This provides the critical link to the end user, the final delivery. Right? This segment operates about 8,400 miles of large-diameter natural gas transmission pipelines, the big interstate systems, plus a large reserve of 74 BCF of underground natural gas storage capacity.
And who are the customers here?
These transmission assets serve essential, often recession-resistant markets, primarily local utility companies, the ones that deliver gas to homes and businesses, large industrial customers, and increasingly electric generation facilities, the power plants.
Okay, so it really rounds out the picture. From wellhead through processing, long-haul transport, storage, fractionation, all the way to the utility or the gas pump.
Exactly.
Yeah.
A vertically integrated, multi-commodity infrastructure leader that can serve virtually every stage of the energy supply chain.
Now, we have to come back to stability. Because when you analyze a massive energy company, the first worry is often price volatility, right? Oil goes up, oil goes down. But you keep emphasizing that roughly 90% of their earnings are generated from fee-based contracts. Explain again why this contractual structure is so foundational to their financial resilience.
It's really the ultimate firewall against those wild swings in commodity prices. The easiest analogy is to think of 1A largely as a toll road operator.
Okay.
They don't really care if the price of the oil or gas goes up or down. They charge a fixed fee, a toll, for every barrel of oil or cubic foot of gas that passes through their system, through their pipelines, their processing plants, their terminals.
So their revenue is tied to volume, not price.
Primarily, yes. Volume throughput. And this contractual structure, where about 90% of their earnings are insulated from that direct commodity price exposure, ensures a much more reliable, predictable cash flow stream.
And that predictability is key for...
It's absolutely crucial for underpinning their ability to maintain an investment-grade credit profile, which in turn is critical for financing future growth projects and just maintaining this massive system at relatively low borrowing costs. Predictable cash flow equals lower risk in the eyes of lenders.
Okay, let's pivot to the financials then. This M&A spree was clearly designed to generate a step change in financial scale. But the history here is important too, right? You mentioned ONEOK demonstrated, 11 consecutive years of adjusted EBITDA growth before these huge acquisitions?
That's correct, 11 straight years. They weren't a broken company that needed fixing. They were actually building from a position of considerable strength and consistent performance.
Which must have given them, and maybe their lenders, the confidence to take on such a massive expansion.
Absolutely. That track record provided the foundation, the credibility to undertake this transformation. And the acquisitions have dramatically accelerated their earnings power as intended.
So what do the numbers look like?
Well, adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a key measure of cash flow, it rose from $5.24 billion in 2023 to $6.78 billion in 2024.
Okay, a big jump already.
Yeah, and that 2024 number only reflected the initial partial impact of the Magellan integration as it closed late in 2023. Now, looking ahead to 2025, the first full year with all major acquisitions integrated.
What's the target?
They're targeting $8.225 billion in adjusted EBITDA at the midpoint of their guidance range.
8.225 billion. That is a truly remarkable, 21% year-over-year increase forecast?
21% jump, yes.
Yeah.
But, and it's a big but, remember, this forecast is heavily contingent on hitting those synergy targets we discussed earlier.
Right. The $250 million in 2025, ramping up towards $450 million plus. Let's talk more about those synergies because the market watches this number like a hawk. That $450 million plus potential, that is a massive promise. What are the different types of synergies management is relying on to actually get there?
Sure, there are generally two main buckets you look for in deals like this. Cost synergies and commercial synergies. Okay, cost synergies sound straightforward.
They are, relatively speaking.
Oh.
Cost synergies are often called the low-hanging fruit. This involves things like eliminating duplicative corporate functions. You don't need two CEOs, two CFOs, etc. Reducing redundant general and administrative or G&A expenses, consolidating IT systems onto one platform, optimizing maintenance schedules and procurement across the much larger combined asset base.
Saving money by combining operations.
Exactly. These are usually easier to identify, quantify, and capture relatively quickly, and they form the base of that initial $250 million target for 2025. But the rest of it, the remaining $200 million or so, the acceleration toward that $450 million plus goal, that relies on the more difficult, perhaps more elusive, long-term commercial synergies, correct?
Absolutely correct. The commercial synergies are where the true strategic value, the real prize of the integration, is locked up. But they are much harder to achieve.
What does that involve, practically?
This involves things like optimizing the flow of volumes across the newly integrated network. For instance, taking crude gathered by the Medallion system in the Permian, processing the associated gas at the nearby EnLink plants, and then piping the resulting NGLs through the legacy OK pipelines down to OK's terminals at Mont Belvieu.
Making the whole system work together seamlessly.
Precisely. And crucially, it involves selling that single, streamlined, wellhead-to-water service package to producers that we talked about. Being able to offer that bundled service allows OK to potentially command better rates, lock in more volumes, and maybe even take market share from competitors who can't offer the full suite.
But that sounds complex.
It is. Capturing this commercial value requires really sophisticated contract negotiation with producers, flawless operational coordination between previously separate systems, and maybe even building small connector pipelines or modifying facilities. It takes time, capital, and expertise, which is why the market often remains skeptical until they see the proof.
So what's the progress report so far? Have they indicated how it's going?
Well, the initial updates, as of late 2024 and early 2025, were generally positive. Management reported that the Magellan synergies, mostly cost-related initially, were actually tracking ahead of their initial expectations.
That's good news.
And the EnLink synergies, which are more complex given the GMP operations, were reportedly progressing as planned. They also seem to be showing discipline on the portfolio side too, right? Not just buying.
Yes, that's an important point. They've signaled that they are not just accumulating assets, but actively refining the portfolio. They announced the divestiture of some non-strategic assets, like certain interstate natural gas pipelines that maybe didn't fit the core liquids and Permian integration strategy.
So selling off pieces that don't fit the new puzzle.
Exactly. It demonstrates a disciplined approach to capital allocation, using those proceeds to perhaps reinforce the balance sheet or maybe fund some of these high-return organic growth projects we'll talk about.
Okay, but this huge transformation obviously came at a cost, namely debt. Acquisitions of this magnitude, we're talking close to $30 billion in total deal value across the three main ones, are rarely cheap. How is the company managing what must be a very high absolute debt load?
You're right, the financing required was significant. It definitely led to an elevated debt-to-equity ratio, which hit a hefty 148% as of June 2025. That kind of leverage requires immediate and focused attention.
So what's the plan?
Their focus is laser sharp on deleveraging, paying down debt relative to their earnings. They have set a very clear long-term target of getting down to approximately 3.5 times net debt to EBITDA.
3.5 times. And now, why is that specific number, 3.5x, the crucial benchmark here? Why not 4x or 3x? That's a great question. In the midstream energy sector, 3.5x net debt to EBITDA is widely recognized by the major credit rating agencies like Moody's and S&P as sort of the optimal threshold for maintaining a solid investment-grade credit profile, typically in the band 2BBB range.
And maintaining that investment-grade rating is critical because
Because it ensures they can continue to access the capital markets, borrow money relatively cheaply. Given their ongoing capital-intensive needs for maintaining the system and funding growth projects, having access to low-cost debt is absolutely vital. Falling into junk territory would make borrowing much more expensive.
So how are they progressing towards that 3.5x goal?
Actually, quite rapidly, which is encouraging. They reported that their annualized run rate leverage based on Q4 2024 earnings had already hit 3.6x by the end of 2024.
Wow, already very close.
Yeah, it signals that the cash flow generation from the newly combined entity kicked in almost immediately and is proving quite strong, allowing for faster than anticipated debt reduction, at least initially.
Okay, so their overall capital allocation philosophy then has to balance this deleveraging priority with investing in high-return growth projects and rewarding shareholders, presumably through dividends. That sounds like a tricky balancing act.
It is, but they seem to be projecting confidence in managing it. On the dividend front, they're leaning on their very long, consistent track record over 25 years without a cut, which is impressive in this sector.
Okay.
And they've guided for modest but steady 3–4% annual dividend growth going forward. They actually approved a 4% increase in January 2025, setting the annualized dividend at $4.12 per share.
So signaling confidence in future cash flow by raising the dividend.
Exactly. And at the same time, they also authorized a substantial $2 billion share repurchase program.
Buying back their own stock.
Yes, and they had already executed about $171.7 million of that by February 2025. The decision to commit capital to both shareholder returns, dividends, and buybacks while simultaneously prioritizing debt reduction is management basically signaling very high confidence in their future free cash flow generation. They believe they can walk and chew gum at the same time.
Right. But we also must factor in the sheer capital intensity of just maintaining 60,000 miles of steel pipe, compressors, processing plants, terminals across all sorts of terrain and weather conditions. What are their ongoing CapEx needs that must be substantial?
The business is inherently capital hungry, no question. Total capital expenditures, or CapEx, for 2025 are guided pretty high, somewhere between $2.8 billion and $3.2 billion.
Okay, but that includes growth spending too, right?
Yes, and critically, we need to separate the growth CapEx from the maintenance CapEx. A very substantial portion of that total, somewhere between $475 million and $525 million for 2025, is designated purely for maintenance capital.
$500 million just to stand still? Essentially, yes, that is the necessary expense just to sustain current business operations. Replacing worn-out pumps, inspecting and fixing corroded pipeline sections, ensuring regulatory compliance, painting tanks, things like that. It's the cost of keeping the system safe and reliable. And that's a really important point for listeners to track, isn't it? That high fixed maintenance cost significantly reduces the amount of truly discretionary cash flow that's available for future dividend increases, share buybacks, debt reduction, or new growth spending.
Absolutely. It's a major call on cash before anything else can happen.
Okay, so ONEOK now has stability from the fee-based contracts and massive scale from the acquisitions. But the market always demands growth, right?
Yeah.
Where's the forward momentum going to come from, beyond just integrating the recent deals and capturing those synergies? Let's analyze the macro tailwinds that are supporting the entire U.S. midstream sector right now.
Yeah, the macro environment is actually extremely constructive for large-scale U.S. energy infrastructure providers, like the new ONEOK. The primary structural driver, arguably the biggest one, is the massive expansion of U.S. liquefied natural gas, or LNG, exports.
Shipping U.S. natural gas overseas.
Exactly. The Energy Information Administration, the EIA, forecasts the addition of something like 5 billion cubic feet per day, BCFD of new liquefaction capacity coming online just in 2025 and 2026.
5 BCFD is a huge amount.
It is, and that's expected to increase total U.S. LNG exports to a staggering 16.3 BCFD by 2026. This creates a powerful structural, long-term demand pull for more high-capacity transportation infrastructure pipelines connecting the major supply basins, especially the Permian.
Where OKE now has a big presence.
Right, connecting that supply directly to the Gulf Coast export facilities where these liquefaction plants are being built.
Okay, so LNG exports are a major tailwind. What about domestically?
Well, domestically, we have a relatively new source of demand that is, frankly, rapidly expanding and catching some people by surprise. It's driven by technology.
You mean AI?
Yes, exactly. We are seeing increasing domestic natural gas consumption driven by the enormous power requirements for the rapidly growing fleet of data centers, especially those supporting artificial intelligence computing clusters.
AI needs a ton of electricity.
An absolutely immense amount, and often the fastest, most reliable way to generate that incremental power, especially on the scale needed, is via natural gas-fired turbines. So this new and potentially very large industrial demand provides a robust, multi-year tailwind specifically for the natural gas pipeline segment. It reinforces OK's position as a critical utility-like provider.
Interesting. So LNG exports and AI data centers are driving demand for gas transport.
Those are two huge drivers. And overall, the U.S. oil and gas midstream market is projected to grow at a compound annual growth rate, or CAGR, of about 3.60% through 2030. Steady growth fueled by these major forces.
So OKE needs to leverage their new massive 60,000-mile network to capitalize on these trends. They call this their expand and extend strategy. What does that actually look like in terms of specific, tangible projects they're working on?
Yeah, the expand and extend strategy basically focuses on pursuing lower risk, generally higher return, bolt-on projects that directly leverage the existing integrated network.
So not building brand new pipelines in totally new areas.
Generally, no. They're trying to avoid risky, large-scale greenfield projects in unfamiliar territory. It's more about adding connections, looping existing lines for more capacity, or building laterals off their main system. Their largest announced growth project right now is the Eiger Express pipeline.
Eiger Express. Okay, what's that?
ONEOK holds a 25.5% joint venture stake in this project. It's planned as a 450-mile, 2.5 BCFD natural gas pipeline.
2.5 BCF a day is significant capacity, and the purpose of Eiger Express is specifically
connecting Permian gas supply directly to those Gulf Coast LNG export facilities that we just talked about.
Ah, okay, so it fits perfectly with the strategy.
Exactly. It's strategically crucial because it links the vast gas supply they secured via the EnLink acquisition directly to the booming LNG markets along the Texas Gulf Coast. It reinforces that whole wellhead-to-water theme.
And the timeline for that?
It's expected to be completed sometime in mid-2028, so still a few years out, but a major long-term growth driver.
Are there examples of growth coming directly from the acquisitions now, demonstrating that commercial synergy they hoped for?
Yes, definitely. We also see immediate organic growth resulting directly from, say, the Magellan deal. A good example is the Denver Refined Products Expansion Project.
Okay, what's happening in Denver?
This is a $480 million project that leverages the existing Magellan pipeline infrastructure coming into the Denver area. It will expand refined products capacity gasoline and jet fuel, mostly by about 35,000 barrels per day, into the greater Denver market.
And serving.
Specifically enhancing connectivity and supply reliability to the Denver International Airport, which is obviously a key consumption point for jet fuel, as well as the broader metro area. That project is slated for completion much sooner, in mid-2026.
So, using the acquired assets to enable new growth almost immediately.
Exactly. That's synergy in action. And finally, just on the reliability front, they're also undertaking the Medford Fractionator rebuild in Oklahoma.
Okay, rebuilding a fractionator. Why is that important?
This project restores about 210,000 barrels per day of NGL fractionation capacity that was previously idled. It's essential for enhancing the overall system reliability and throughput capability of their massive NGL system, particularly the parts gathering liquids from the Mid-Continent region. Got to keep the existing system running smoothly, too.
Right. Reliability is key when you're moving that much energy. Okay, so this M&A activity hasn't just increased OK's size. It has dramatically improved its competitive positioning, hasn't it? It's really propelled them into the absolute top tier of diversified North American midstream operators.
No question. They now compete head-to-head on scale and scope directly with the established industry giants. Companies like Enterprise Products Partners, EPD, Williams Companies, WMB, Kinder Morgan, KMI, and Energy Transfer, ET. They're in that league now.
So what are their key competitive advantages now? What's their moat?
Well, the competitive moat is now significantly deeper and wider than it was before. They possess several powerful, durable advantages. First is just the sheer scale and integration of that 60,000-mile multi-commodity network. That creates operational leverage and supply chain efficiencies that smaller, more specialized regional competitors simply cannot match.
Hard to compete with that size.
Very hard. Second, and this is crucial, the barriers to entry in this sector are astronomically high. You simply cannot replicate this kind of infrastructure network overnight, or maybe even over a decade.
Why not?
Well, think about the immense capital required, tens, if not hundreds of billions of dollars, the incredibly long construction lead times, and maybe most importantly, the complex and often contentious federal and state regulatory processes required to permit and build new pipelines today. It's incredibly difficult.
So their existing, already built, irreplaceable infrastructure is really their core economic asset.
It absolutely is. It's a massive, entrenched competitive advantage.
But perhaps the most compelling advantage now, the one that really justifies the whole complex integration strategy, is that one-stop shop advantage they potentially hold, especially for producers in the Permian Basin.
This is the commercial leverage. This is the ace up their sleeve that the market is, frankly, still waiting to see fully realized in the numbers. Because of the combination of EnLink for GMP, Medallion for crude gathering, and the legacy OKE, acquired Magellan long-haul pipes.
They can offer everything.
Right. OKE can now go to a producer in the Permian and offer a single, bundled commercial package for handling all three of their main commodity streams, their crude oil, their natural gas, and their NGLs, from the point of extraction, the wellhead, all the way to the final market hub on the Gulf Coast.
Which must simplify things dramatically for the producer.
Hugely. It simplifies their logistics, reduces the number of contracts they have to manage, potentially provides superior reliability and flow assurance because it's all on one integrated system, and most importantly from OK's perspective, it creates deeply sticky customer relationships.
Sticky meaning hard for competitors to break.
Exactly. It's extremely difficult for less integrated peers, companies that maybe only offer gas processing or only crude transport, to challenge that bundled offering effectively. The producer benefits from potentially reduced counterparty risk and maybe even optimized transportation costs across the board. It's a powerful value proposition if OKE can execute it seamlessly.
Okay, so if the strategy is so brilliant on paper, and the scale is now so large, and the competitive advantages seem so strong, why is the market apparently applying a penalty? Let's address the elephant in the room. The valuation dynamics and this so-called complexity discount.
Yeah, the complexity discount is real. You can see it in the numbers, and it really reflects the market's inherent and perhaps historically justified distrust of rapid, large-scale, complex integrations. M&A history is littered with deals that looked great on paper but failed in execution.
So what does the discount look like specifically for OK?
Well, historically, before this M&A spree, ONEOK's price-to-earnings ratio, the PE ratio, averaged somewhere around 22.9 times over the prior decade.
Okay, a fairly high multiple reflecting its growth history.
Right. But as of mid-October 2025, after all these deals closed and the integration risk became apparent, that PE ratio had contracted significantly, down to approximately 13.5 times forward earnings estimates.
Wow, that's a big drop. So the market is basically saying, we don't fully believe your future earnings potential yet.
That's exactly what it's saying. They're not yet willing to give full credit for the pro forma earnings figures that include all the projected synergies.
And how does it look compared to peers on, say, an enterprise value to EBITDA basis? That's a common metric in this sector.
On an EV and EBITDA basis, they also look discounted relative to some key peers.
Mm-hmm.
OK was trading around 10.3 times forward EBITDA estimates around that same time frame, mid-October 2025.
And how does that stack up?
Well, it's maybe slightly above or in line with some of the large master limited partnerships or MLPs, like Enterprise Products EPD, which is around 10.4x, or MPLX around 9.5 by 10.0x.
But lower than other large C-Corp.
Significantly lower than highly integrated C-Corp peers like Williams Companies, WMB, which often trades in the 15.5x to 16.6x range, or Kinder Morgan, KMI, which is typically around 13.0x to 13.2x.
So why the penalty compared to a Williams or a Kinder Morgan? Is it just the integration risk?
Primarily, yes. The market is skeptical about the execution risk associated with integrating so much so fast. The discount clearly signals a show-me stance from investors.
Prove it first.
Exactly. Investors are concerned that integrating 5 disparate IT platforms, trying to combine potentially very different corporate cultures, and, most importantly, successfully capturing those really complex commercial synergies, the ones that rely on optimizing contracts and volume flow across the whole system, will inevitably lead to missteps, delays, or maybe just lower than promised results.
And they need to hit that big $8.2 billion EBITDA number for the valuation to make sense.
Absolutely. And we saw evidence of this market sensitivity, didn't we? The sharp negative stock reaction when they reported a slight miss on their first quarter 2025 earnings guidance showed precisely how sensitive the market is to any sign, however small, of potential execution failure or synergy delays. They have very little room for error right now.
Okay, so the entire investment case really seems to rest on execution. Given the sheer scale and the unprecedented speed of this consolidation, what is the single most significant and immediate risk facing ONEOK right now? We need to get specific here.
Without a doubt, the overwhelming risk is execution and integration failure. And this is more than just potentially missing some cost savings targets on a spreadsheet. It's about the risk of actual operational disruption.
Meaning things actually going wrong on the ground.
Yes. Integrating 5 separate companies, 5 different operating philosophies, 5 IT systems in just 24 months creates this crucible of challenges. We're talking about merging different enterprise resource planning, ERP systems, the software that runs a business, harmonizing different safety standards and operational protocols across thousands of miles of pipelines and dozens of facilities, and managing the inevitable cultural friction that arises when you merge organizations that were, in some cases, historical competitors.
And if that integration stumbles?
If the systems don't talk to each other seamlessly, if billing gets messed up, if nominations for volume get dropped, or there's significant turnover of key experienced operational personnel post-merger, then volumes can drop, costs can rise unexpectedly, and the entire strategic rationale for the deal starts to evaporate. The synergies don't materialize.
Okay, that's the big operational risk. What about the financial pressure created by the acquisitions? How serious is the financial risk stemming purely from that elevated debt load we discussed?
Well, the financial risk is essentially the high cost of failure if that operational execution falters. While management, as we noted, is making rapid progress on getting the leverage ratio down towards 3.5x.
Hitting 3.6x run rate quickly.
Right. But the absolute dollar amount of debt on the balance sheet remains substantial. So if their EBITDA were to underperform expectations, maybe because they failed to capture those synergies, or perhaps due to a steep, sustained market downturn impacting volumes, that 3.5x target could slip away again quite quickly.
And the consequence of slipping above 3.5x for too long.
Any sustained period significantly above that level would almost certainly put their investment-grade credit ratings at risk. Downgrades would mean the company has to pay higher interest rates on its debt, which would further strain cash flow, reduce the capital available for shareholders or growth investments, and potentially create a negative domino effect. It really narrows their financial flexibility.
And we can't completely forget the fundamental market risks, right? Even with that 90% fee-based structure providing a buffer.
That's right. While they are largely insulated from direct commodity price volatility, they are not completely immune to volume risk.
Explain that distinction.
Well, that remaining 10% or so of their earnings that is exposed to non-fee-based arrangements, primarily within the gathering and processing segment, is definitely sensitive to throughput volumes. And even the fee-based contracts rely on volumes actually flowing. So if we were to see a period of sustained, very low commodity prices that causes upstream producers to drastically cut back on drilling activity.
Fewer new wells being drilled.
Right. Or maybe they drill wells but don't complete them, the drilled but uncompleted or DUC inventory grows. If that happens on a large scale, then the volumes of gas and NGLs flowing through OK's GMP systems will inevitably decline, and that would directly impact that portion of their earnings power, potentially making it harder to hit those overall EBITDA targets.
Okay, so integration risk, financial risk from debt, and underlying volume risk. How is management trying to mitigate these significant challenges, particularly the integration and operational ones?
Well, based on their public statements and actions, they seem intensely focused on continuity and accountability. One key indicator that suggests they're trying to mitigate the operational risk is the deliberate retention of seasoned, experienced operational talent from the acquired entities.
Keeping key people from Magellan, EnLink, Medallion.
Exactly. For example, retaining Randy Lentz, who is the founder and CEO of Medallion Midstream, as an executive vice president and chief operating officer for the combined company provides essential leadership stability and, crucially, deep institutional knowledge regarding those newly acquired Permian crude assets. Similar moves were made with key Magellan personnel like Jamie Hoskin. That continuity is vital during a complex integration.
That makes sense, keeping the people who know how the assets actually work. And you mentioned something earlier about a fascinating detail regarding their executive compensation structure. How does that play into mitigation?
Yes, I thought this was quite telling. The board's compensation committee made a very specific, and I think shareholder-friendly, decision regarding the 2024 short-term incentive plan, the annual bonuses for executives.
What did they do?
They explicitly adjusted the performance metrics for that year to exclude the purely financial accounting-related impact of the recent acquisitions.
Excluding the M&A impact. Why is that crucial?
It's crucial because it ensures that management's pay, their bonuses, are explicitly tied to the underlying operating performance of the combined asset base, things like controlling costs, improving efficiency, maintaining safe operations, and actually growing volumes organically. It's not just tied to the paper increase in scale that comes from M&A accounting or hitting synergy targets that might be easy to fudge.
So management is directly incentivized to make the actual pipes flow better, safer, and more profitably.
Precisely. It aligns their incentives directly with the long-term operational health and value creation for shareholders, rather than just rewarding deal-making itself. It's a subtle but important governance point.
Okay, let's try to formalize the two opposing investment theses for the listener, trying to make sense of all this. What defines the bullish case for ONEOK now? What has to go right?
The bullish thesis essentially argues that ONEOK is fundamentally undervalued today, precisely because of that complexity discount we discussed, and that discount will eventually narrow or disappear as they prove their execution capabilities.
So what needs to happen for the bulls to be right? For this to succeed, management basically has to deliver on all fronts. First, successful, relatively disruption-free integration of all the acquired assets and systems. Second, the full realization of that $450 million plus target in total annual synergies, both cost and the harder commercial ones. Third, on-time and on-budget completion of those key organic growth projects like the Eiger Express pipeline and the Denver expansion. And fourth, critically consistent deleveraging down to that 3.5x net debt to EBITDA target and maintaining it. If they do all that,
If they achieve all that, success should lead to strong, visible earnings growth, improved free cash flow, and ultimately a positive re-rating of the stock's valuation multiple, potentially moving it closer to those high teens EBITDA multiples seen by some of its large, well-integrated peers.
okay, that's the bull case. Conversely, what should a listener track if they think the bearish thesis, the view that the risks outweigh the rewards, is more likely to play out?
The bearish thesis is centered squarely on that execution risk. The argument is that the sheer complexity of integrating 5 companies so quickly is just too high a hurdle.
What would confirm the bearish view?
If the complexity leads to protracted operational disruptions, system outages, customer service issues, safety incidents, or significant cultural clashes that lead to loss of key talent, or perhaps most damagingly, a clear failure to meet those crucial commercial synergy targets, meaning they can't actually realize the enhanced margins from the integrated system. If those things happen, the whole investment case falters.
And the downside?
A combination of missed EBITDA targets, potentially coupled with a severe market downturn that strains the still high debt load, would likely justify the current discounted valuation, or even push it lower. It could potentially result in credit rating downgrades and force management into difficult choices, possibly including reductions in capital returns to shareholders like dividends or buybacks.
Okay, two clear competing narratives centered on execution. So let's wrap this up. We've covered the truly monumental change at ONEOK, a strategic shift that transformed them from, a successful but regional NGL player into a national, diversified, multi-commodity infrastructure leader spanning an incredible 60,000 miles.
A massive transformation. And the investment thesis, as we've hammered home, hinges almost entirely on synergy capture and flawless execution of this complex integration.
The question now is, how can you, the listener, track that execution in real time? What should people be watching?
Yeah, that's the key takeaway. I suggest focusing on 3 critical signposts to monitor in the coming quarters. These will really signal whether the bullish or the bearish thesis is gaining the upper hand.
Okay, signpost number 1.
First, Rigorously monitor the quarterly reported capture of synergies. Don't just look at the headline number. Dig into the management commentary. Look for details distinguishing cost savings versus the more valuable, harder-to-get commercial synergies. Also, watch the underlying volume trends in the 4 distinct business segments. Are volumes growing, flat, or declining?
Okay, track synergies and volumes closely. Signpost number 2.
Second, confirm the continued downward trajectory of that net debt to EBITDA ratio. Ensure it keeps moving relatively quickly and definitively below that recent 3.6x mark towards the crucial 3.5x target and stays there. Any reversal or stalling on deleveraging would be a major red flag.
Got it. Deleveraging progress. And the third signpost.
Third, look for specific updates on the timing and budget of those major organic growth projects, especially the big one, the Eiger Express pipeline. Are they staying on schedule? Are costs remaining under control? Any significant cost overruns or delays on these key projects could impact future growth expectations and put pressure on the balance sheet.
Synergies, leverage, project execution. Okay, those seem like clear, actionable monitoring points. So what does this all mean in the long run? What's the final provocative thought we can leave our listener with to consider?
Well, here's where it gets, I think, really interesting and maybe a bit more philosophical. While the market right now is understandably obsessed with the tangible risks of integration, the IT systems failing, the debt ratios ticking up, synergy targets being missed.
The measurable stuff.
Right, the stuff you can easily put in a spreadsheet. But the company's core long-term economic value might actually be somewhat hidden, or at least hard to quantify right now. That network effect, the value created by having this massive, interconnected, effectively irreplaceable 60,000-mile system.
The whole being greater than the sum of its parts.
Exactly. That system, capable of offering that unique bundled service from the wellhead to the Gulf Coast for multiple commodities simultaneously, that capability itself is a powerful, intangible asset. It creates operational efficiencies and potential customer lock-in that may still be significantly undervalued by standard accounting metrics like book value or even simple EBITDA comparisons against less integrated peers.
So the market might be missing the true long-term strategic value.
It's possible. The ultimate commercial potential of this massive, integrated system, the ability to optimize the flow of every barrel of oil and every molecule of gas across the entire network in a way no competitor can easily replicate that potential, is the primary uncertainty right now. And ultimately, whether they can fully unlock that potential will likely be the primary determinant of whether OKE simply stabilizes as a larger company or fundamentally transforms its long-term market valuation and truly becomes a premium infrastructure leader. That's the big question to ponder.